Leadership involves finding a parade and getting in front of it. Leadership lessons from John Naisbitt, author of Megatrends. We're talking about leadership in markets, winner-take-all economy, and the changing face of the Indian stock market with Utpal Sheth. Utpal, welcome back. 2003. Someone told you, "Pita main hu, chad gayi hai tere ko." I am drinking, you're getting drunk. What caused that outburst, and who was it?
It was 2004, and it was Rakesh,
Your boss?
much more than my boss. And the company in question was Titan.
Clearly.
We were making a presentation to the Titan management team, and I had worked out our mathematical models and made projections over a 5-year period. The presentation was to be the next day morning at 10 a.m. and Rakesh and I were reviewing it at 2 a.m. the previous night.
Right.
And when he saw the numbers, he said, "You've lost it."
You're getting drunk, punch drunk.
Yes, though he very well knew that I don't drink. And then, but he agreed with the direction, if not with the destination. He agreed with the direction, and he was the visionary. He had bought the shares even before I had joined Rare. But I think this whole exercise gave us added conviction, a much larger perspective of Titan. And when even the Titan management team saw the numbers that I had projected, they thought that I had lost it. But the reality is, if you fast forward 5 years later, the Titan management team had achieved the top line in the 5 years that I had projected, which they thought was impossible, and they achieved the bottom line with 1 year lag.
You knew that at that time that this was going to be a super stock?
I knew that this will be a great company. I didn't know that this would be a super stock. So
they go hand in hand.
They do go hand in hand over a period of time, but there are significant lead lags. So I was quite clear that this would be a great company.
You actually told them to change their model, right? To focus on jewelry as opposed to watches. Why?
After joining Rare, when I first went to Titan, I realized that Titan was deploying its best talent in the watch business,
right,
which had great margins, and not in its jewelry business, which had significantly lesser margins. However, during my calculations, I realized that the return on capital employed on the jewelry business was significantly greater than the return on capital employed for watches. More importantly, the scalability of the jewelry business was far greater. And to me, return on capital employed and scalability are two big mantras for long-term value creation for the company and wealth creation for the investors.
But you even took a company like Shree Cement and made it sexy. How do commodity business become sexy?
I came across Shree Cement when I was part of Enam, and Shree Cement, I realized, was this regional cement company, but I realized that this company had not diluted, that this company was the lowest cost producer in the country, better than Ambuja Cement at that time. More importantly, within its region, it was a market leader. It had a 20% market share, so its EBITDA per ton was going to be the highest. So we had a fantastic 3-tiered story. In the first year, the cost reductions would drive the profits. In the second year, the realization improvements would drive the profits because no new capacity was coming up in that region.
Correct.
And in the third year, Shree Cement's own capacity was going to come up, and that would drive the profits.
But for the record, how did the stock do?
Well, Shree Cement at that time was around 25-30 rupees, if I remember right, and you know that it's more than 10,000 today.
So it's been one of the glamour stocks. But not all fairy tales end well. Not every Cinderella finds
Prince Charming.
Prince Charming. Couple of stocks that didn't work out. Bill Care, A to Z. What went wrong there?
I think capital allocation, compounded in many ways by poor capital structure as well. So it's actually a vicious circle. First, the return on capital employed being generated out of the business was poor. So while the companies were driving a lot of growth, because the return on capital employed was poor, the free cash flow generation was not there.
Constantly need equity.
you would need external funding, either equity or debt. So they would keep diluting, or they would take debt, and at some point of time in the cycle, it gets messed up. The debt is the enemy of compounding everywhere, be it in a company or be it for the investor.
These are great lessons to learn. Of course, what does make a great company? We'll look at all of that in the next segment after this break. We'll come back and chat some more with Utpal Sheth of Rare Enterprises.